Hello and welcome to this great investors edition of Wealth Track. I'm Consuelo Mack. When you think of hedge funds, the last qualities that come to mind are transparency and accessibility. But this week we're going to meet a hedge fund manager who is known for his outspokenness and actually seems to enjoy the public spotlight. Well, one reason could be that he is marketing his hedge fund strategies to Main Street investors via a lineup of new mutual funds. His name is Cliff Asness. His firm is AQR Capital Management. And at the height of the hedge fund boom, the then 10-year-old firm had one of the best track records in the business and $40 billion under management. Well, last year, the firm suffered brutal reverses, losing half of those assets. AQR is still running hedge funds, but it is also branching out into mutual funds. In early 2009, it launched the AQR Diversified Arbitrage Fund. Well, Cliff Asness has been one of the biggest names in the hedge fund world. He has a PhD in finance from the University of Chicago and began his financial career at Goldman Sachs, where he became director of quantitative research for the asset management division. In 1998, he, along with a team of Goldman colleagues, started AQR, a firm that is known for its value orientation and quantitative computer-driven strategies. In a recent interview, I asked Asness to explain what quantitative investing means to him.
We use quant, and I think most people will use quant simply to pursue something that they believe in already. It's not the tail wagging the dog. It's not that we found some weird pattern and let's trade it. It's we believe that value wins over the long term. We believe that if you combine value with some trend-following strategies, it keeps you safer than pure value. We believe that all else equal, being paid positive carry to weight is a good thing. All else equal. Sometimes it can be scary. These are general investment beliefs. Quant is about doing it in a very diversified way, a very disciplined way, minimizing your transactions costs, and not making the wrong decision at the wrong time. We try, and it's always an effort, not to have the computers in charge. We have an investment philosophy. We like to be long cheap and short expensive. We like to be, or over and underweight if we're running a more traditional portfolio. We like to be long positive news coming out, good momentum, both in price and fundamentals, and short the opposite. We like to be long things that pay us to wait and short things that where we get paid to be short them. You can't always get all at once. We use the computer to figure out where those situations are, put them on in a diversified way, and very importantly, try to control our costs in investing. One thing, when you're buying 10 stocks, you might be great at it, you might be terrible at it, but it really doesn't matter if you pay too much. It comes down to whether you're right about the stocks. When you're buying 1,000 things and you're selling 1,000 things, you might be great, you might be terrible, but if you're great at a small edge. If you pay a little too much, you suddenly have a small negative edge. And a small negative edge adds up to very, very bad if you do it for 20 years. So we use the quant really to be disciplined, to control our risk, to control our costs, but not to really tell us what to buy and sell. That comes from really a value investment philosophy that overrides everything we do. And then the quant part is about doing it with rigor. One more thing to add, you need the quant part because if I tried to do it myself, I'd get it wrong all the time. Because one of the reasons we believe value works over the time, and this is...
And this is like the Graham and Dodd type of value?
This is, you know, we all have our own models, but it's not that different. Mm-hmm. It's price compared to all kinds of intrinsic basic earnings, cash flow, sales. You know, everyone has their own models for it. But one of the reasons we believe it works over time is it makes you do some very uncomfortable things. It makes you buy the thing that makes you kind of go, oh, I can't believe I'm buying this. You show someone a value portfolio, they wince. You show them what you're underweight or short, and they feel terrible. They're like, what, are you kidding? Those are great companies. Turns out they're right. These are worse companies that you like, and these are better companies that you're short, but not by the margin that's built in the price. So if I were sitting there looking and not using a computer, not using a quant model and overriding, I think I'd be just as susceptible as everyone else to go, oh, that seems terrible. So a lot of it is about holding you to your philosophy, about doing the, we like to say in our field, we get paid for doing the uncomfortable thing. You don't get paid for doing the comfortable thing. You got to pay to do the comfortable thing.
Now, you're also a big believer in very broad diversification. Yeah. So what does it include, you know, at AQR Capital that other people who have quote-unquote diversified portfolios don't include?
Sure. For one, I'm not going to comment at all on the illiquid assets, the private equities and the real estate. We don't do that. I don't think it would be amenable to a model-based approach. But among the liquid assets, there's a very large diversity of what you can do. There are stocks around the world, bonds around the world, corporate bonds around the world, commodities around the world, tips in many, many countries, more than the U.S. all kinds of different credit and mortgage assets. Some of the dirty words of finance in the last couple of years are, in fact, good long-term investments. So number one, we believe in buying as broadly as we can. Even if things are correlated, even if they move together, they don't move perfectly together. Second of all, we believe in global diversification. You probably have heard people actually knock global diversification all the time, and the common knock is it doesn't help you because when we get a crash, everything crashes together.
Like
now.
2008.
Absolutely.
Right.
The funny part about arguing with that is, first of all, the first thing you got to do is admit it's absolutely true. And then you got to say why it doesn't really matter. Because it's not about weeks, months, or years. If you look at 5-year and 10-year periods, every country that we've looked at at least about 10, 15 countries now, and certainly we do them in order. We don't start with the tiny countries, of course. We do them in economic order.
Right.
Every country we've looked at, worst case, if you only stayed in your own country, is not a little, but a lot worse than its worst case if you were a global investor from that country when viewed over 5 or 10 years. When viewed in 1 year and in, its worst case is almost the same, because that's about a panic. Worst case at 10 years is about you turned out to be Japan in the 90s. And so we believe in global diversification for the long term. And finally, and this one is maybe the most subtle, and I alluded to it when we were talking a few minutes ago, we think people underinvest in a broad set of assets that are mainly about reducing your risk, not about making money. Stocks are really about making money.
And they're risky.
They're risky, and their headline is how much they go up over time. Bonds are about reducing your risk. They're about reducing your portfolio risk. Commodities might be volatile, but they actually often reduce the risk of a portfolio because they often have this almost no relation to the direction of stock markets. We tend to believe, and we think we have the data to back it up, but our belief is the assets that work to reduce your risk, not the headline number, are underappreciated by investors. Underappreciated means underpriced. Underpriced, just to complete the mathematical equation, underpriced means over-expected return. You make too much money from them. So I wouldn't say put all your money in bonds, but our recommended diversification is, if you, for instance, if you don't follow it, if you just do the traditional invest in 60-40 stocks bonds, well, that, in terms of whether you make money this year, that's about 93% about whether stocks go up. They're so much more volatile than bonds, they swamp bonds. Mm-hmm. So we do believe in a truly diversified portfolio. It's global, but then it's more balanced by risk than by dollars. So in a low-risk asset, we do more of it, and in a high-risk asset, we do less of it, and we think it comes out to a more controlled and more steady and a little bit better of a gain over time.
What would a balanced portfolio be for you at AQR?
We end up being equally weighted across 4 asset classes. There's no magic to equal. It's very hard to believe the exact answer. If you were able to speak to God and he told you, here's the right portfolio, that it would exactly be 25% in each of these. But when you're close to equal, you go with equal. So I'm not claiming it's precisely right, but it's close to right. We think it's close to right. The second thing I'll say is I mean 25% by risk. So if bonds are a third the volatility of equities and commodities are double the volatility of equities, that means all else equal, we own half the commodities of equities because they're double the volatility, and 3 times the bonds of equities. So we're taking the same risk in each of them. Now finally, those 4 buckets are really equities, government bonds, what we call real assets, which really come down to both commodities and inflation-protected government bonds. And finally, what's been the poster child for the problems, but even with those, the whole package has done fine because the government bonds have been elevated. The poster child for the problems lately have been the 4th bucket, the credit bucket. Those 4 at relatively
and the
equal.
credit bucket has in it corporate bonds?
They have corporate bonds,
mortgage-backed
all the bad things. You mentioned something bad, corporate bonds, mortgage-backed securities, commercial mortgage-backed securities. They were in the news today with being added to the various federal programs and whatnot. But it's all the stuff that's been ugly. But you know something? It certainly has been ugly for the last year, but being very overweight in government bonds has been quite wonderful, and it's more than balanced it. And over the long term, no one wants to own them now, but over the long term, these assets make money.